Bismillahirrahmanirrahim. In the wake of the global financial crisis, it has become obvious to all that there is a dire need for regulation of financial markets. Many efforts are being made along these lines, but very few consider them to be adequate or sufficient for the needs of the times. In order to get a better understanding of why current approaches are not working very well, this paper is devoted to the analysis of the Islamic approach to regulation. When compared and contrasted with this, we will see why current efforts are inadequate and also the ways that they can be changed to improve them and to make them effective for our current needs. So Islam offers us a three-dimensional approach to regulation. At the first and most fundamental and important level, we have behavioral constraints, moral norms which are binding on individuals, and also social norms which regulate how we should behave in society. In particular, self-seeking and self-serving behavior like greed is very strongly discouraged, and the act of sacrificing self-interest for the sake of the social good is very strongly encouraged, and this can be illustrated by many verses from the Quran, ahadith, and many stories of the leaders of the Islamic world, heroes. At the second level, we have structural and institutional controls. These actually are rules for transactions which are meant to prevent transactions which are harmful to society. The most well-known of these is the prohibition of riba, but also there are many other regulations along this line. For example, the seller should display and explain any defects. He is not allowed to conceal defects in the product that he is selling. Similarly, transactions which involve too much uncertainty are also banned. For example, if I sell you an oil field, but there is substantial uncertainty about whether or not oil is to be found, and the value of the land depends greatly on this, then such a sale is not permissible in Islamic law. So there are many types of structural and institutional constraints which are designed to protect buyers and sellers from doing transactions which are harmful to one party or the other, and also cause damage to society as a whole. At the third level, there is what is normally considered regulation, and that is to prevent certain kinds of irregularities, and also to specify sanctions and penalties which will be provided if somebody violates these behaviors. So this is, in some sense, the least important type of regulation. That is, it comes into effect only when the first two things fail. If some individual violates the rules and goes beyond the bounds of the transactions, then these regulations will serve to keep him in line. These do have a role, and sometimes an important role, but this is only the last ditch defense after everything else is broken down. So in some sense these are not the central pillars of Islamic regulation. Now I will elaborate on each of these three components separately. So the first, we have the social controls. These involve developing character of individuals and also developing social norms. The social norms are those of cooperation. The Quran says that we should cooperate with each other in doing the good. These are norms of community. The human beings are reminded that they are all from one family, and that we should not allow differences of race or language or of any other sort to separate us from each other. That Allah Ta'ala put the love in the hearts of the community, and that this love is a treasure greater than all of the wealth on the planet can buy. So there are many laws relating to the rights of the neighbors, and many ahadiths which stress the importance of having love for each other and being courteous and kind and displaying good conduct towards each other. So all of these are meant to create cooperation and community. In addition, there is a very strong emphasis on responsibility, that the weak and the oppressed and the needy within any community are the responsibility of the community. So the community as a whole must take care of all of its weaker and less well-to-do members. Also, there's the idea of the service orientation, which is very much against what is being taught in the MBA programs in the secular world. This idea is that we run a business or we have a shop. The object of our efforts is to provide service to the community for the sake of the love of Allah. The object is not primarily to earn profits. In fact, profits are a means to the end of providing service. This is exactly opposite to the Western view or the secular view, that service is a means to earn profits. We provide service, we sell goods so that we can make money. The bottom line is the only thing which matters. This view is completely reversed in Islamic teachings, which emphasize that our goal should be to provide service, and we can earn money in the process so that we can continue providing this service for a long time. This dramatic difference makes a large amount. This is a dramatic difference which makes many things different, but since this is not the goal of our talk to focus on this, we just mention this and continue. Now finally, one thing that is important to note is that why does conventional economic theory not deal with these issues? Well, the main reason is that it is taken for granted that human behavior is fixed and cannot be changed. So this is taken as an exogenous factor. This is not true. Human behavior is very malleable and it can be shaped by many forces. We can teach children to be generous, we can teach them to be selfish, we can teach them to be cooperative. Children are born with social instincts, and if these are strengthened and nurtured, children will grow up to be kind and cooperative and courteous. If we stunt those instincts and push them in other directions and train them in other directions, they will grow up to be selfish and cruel, for example. There are many instances which show that the idea that behavior is exogenous is wrong. Many cases where behaviors have been changed. One example is that of Tokyo Lost and Found, where a campaign was conducted to make sure that people who dropped things or lost things, other people who found them would return them. And this campaign was extremely effective, and the social norm that if you pick up something or you find something, you should return it to the owner, and you should try to make an effort to do this, was created by a process of training. This is just a trivial example, but it shows that by choosing goals for ourselves as to what types of behaviors will be encouraged, we can change those behaviors and we can bring about desirable results. And this is quite contrary to standard economic thinking. Before we look at the other two dimensions of the Islamic approach to regulation, it is useful to backtrack a little and look at why European approaches do not follow these lines. For that we have to go into history, which is rather long and complex, and at the moment I will just cover it very briefly. Basically, over the past century or so, Europeans experimented with a new methodology for growth and development, which has failed, and the fact that it has failed has only recently become clear to all. So we need to look at this experiment. Basically, the experiment was that based on the idea that the accumulation of wealth is the solution to all human problems. This idea has also proven to be wrong. Now the second ingredient in the European experiment was the idea that if we just allow people who are greedy to accumulate wealth, then wealth will accumulate in the society, and this will lead to desirable results. So the idea was that we can encourage people to be greedy and selfish and ambitious, and because these are very powerful forces within a man, so this will lead to the fastest accumulation of wealth. So we allow cutthroat competition, and we allow greed and selfishness, while recognizing that these are not necessarily good things. So if we allow these things, then everybody recognized that there would be harm done by people who are selfish and people who are trying to eliminate competitors, and so regulation is necessary. And so the European experiment was based on a dual model. The dual model was that on the one hand, the traders and the other actors in the economy would greedily and selfishly promote their self-interest and thereby lead to a maximum and rapid accumulation of wealth in the society. On the other hand, there would be these wise and just philosopher kings who would make sure that nothing unfair happened, that all of this competition and all of this greed was within the domain of the law. These people would watch over the society as a whole, make sure that the playing field was level, that the competition was fair, and make sure that things didn't get out of hand. So this was the idea. It was a radical and revolutionary idea, because traditional societies said that these things are bad, that one should have cooperation instead of competition, and one should have generosity instead of greed. And the Europeans thought that these were an obstacle to progress. The conventional and traditional morality was an obstacle to progress, and things could move much faster if these obstacles were removed. So this was the experiment that was tried over the past century, and it has failed dramatically. Greed, accumulation of wealth, hoarding, selfishness, all of these things were considered bad qualities, but in a gradual process that took centuries to accomplish, these bad characteristics came to be regarded as being good. There were many complex historical reasons for this change, which cannot be traced here, and they have been studied in many books. Just for the sake of illustration, I mention a few key transition points. At the beginning of the 20th century, Max Weber said that, and studied and proved that, the spirit of capitalism is the pursuit of wealth for its own sake to the point of being irrational. Meaning that when we pursue money, when we seek wealth, the rational pursuit of wealth is when we want to use wealth to do something that we cannot do otherwise. But to pursue wealth for its own sake, just to accumulate a lot of money, and that make that the goal, that is irrational, because wealth is not an end in itself. It is a means to achieving some other end, something we would like to do, to eat or drink or to wear or to build houses or do something with it. So similarly, Keynes said that the love of money is a disgusting morbidity. It's a very bad thing. It's a psychological disease. But nonetheless, he said that we must encourage it because it will allow the wealth to accumulate. And once enough wealth accumulates, then we will be all rich, and then we won't have to worry about these things. So these early people recognized that pursuing wealth was not a good thing in and of itself, but it might be needed to do something else. However, later on in the 20th century, Friedman said that making profits is the only business of business, and he absolutely said that the businesses should not take their money and use it for charitable projects or for social benefits. They should only be concerned exclusively with making money, while remaining bounded within social and between the legal framework, of course. Finally, in Wall Street, you have the sentiment of Bosky in the 90s that greed is good, and this has now become the dominant feeling, that anything you can do to make money, regardless of whether it's ethical or moral, if you make money, that's good. If you lose money, that's bad, and there is no constraints, no morality, nothing which prevents you from pursuing wealth in any way possible. The idea is that the world is a jungle and there's cutthroat competition, and anything you can get away with is fine. So this current feeling has led to a lot of damage, and the most visible of these is the global financial crisis of 2007, where the bad effects of greedy pursuit of wealth became clear for all to see. But there are many other um, ways that we can demonstrate that the idea of allowing greed to generate wealth has not worked out very well. The idea, even now being taught in MBA programs all over the world, that profits come above everything and everything can be subordinated to the making of profits. This has led to wars, it has led to environmental catastrophes, it has led to social breakdown. It has so many dimensions in which this idea has led to harm and damage to humanity as a whole that it is hard to even list all of these. So we'll just confine ourselves to a quote from a professor who taught in the Harvard MBA program, and she said that basically this idea, teaching the MBAs that your only job is to pursue profits, has led to a lot of harm and damage. It has caused widespread suffering, destabilized the economy, and actually led to the collapse of capitalism. So this is not our main goal in this talk, so we will not pursue this idea further, but basically the need for regulation as conceived in a capitalist system is very different from the same idea within Islamic society or even within a human society which is based on more well accepted social values. In the light of this understanding of contemporary methodology for running business, which is being taught worldwide in MBA programs and therefore being absorbed by business leaders all over the world, the Islamic approach is quite revolutionary. The macroprudential approach, which is currently being pursued, is that we should allow greed, we should allow corporations to make profits, but and to pursue profits wholeheartedly, but we should regulate this to make sure that no harm to society results from this. Now, the practical on-the-ground effects of this approach are reflected in this letter that Greg Smith wrote when he resigned from Goldman Sachs, and he said that when I joined the company, we had a culture of service. We were trying to serve the people who invested and to help them to make money in a socially responsible way. However, he says that this has completely disappeared and changed, and now the whole object of the firm is to make money for itself. In this process, they don't care if the investors are harmed, they don't care if the world is harmed, they don't care if the others are harmed. So it's all completely one-sided pursuit of wealth for its own sake without any regard for others. And he found this disturbing, so he resigned. And what he said is true of a large number of cases, and there's a large number of corporate scandals which show how firms have been trying to make profits at the expense of everybody else, the whole society, nations, anything. So in this respect, the Islamic approach starts with the social conditions. The focus would be not on regulating the firms, but of changing the corporate culture. We should make it service-oriented. We should make it responsible, socially responsible. We should encourage cooperation and community orientation, we should understand that a corporation which operates within some community is responsible for the lives of the people in that community, and it has social responsibility. This is exactly opposite to the Friedman idea that the only job of business is to make profits. No, profits are not primary. Rather, we live in a community. Human beings and human lives are our first responsibility, whether it is individual or whether it is corporation, which is just a group of humans working together to do some job which should be socially beneficial. In order to understand why existing approaches to regulation cannot work, because they are one-dimensional and do not go to the root of the problem, it is very useful to review the history of financial regulation in the USA. There was no such thing until the Great Depression of 1929. Why did this occur? Well, basically it was because there was a boom in the stock market. The reasons for this boom was basically the same as those that Schiller has discussed in his book called Irrational Exuberance. When stocks are rising, everybody expects them to keep rising, and there's a frenzy of speculation which feeds this irrational behavior until at some point the things go so far out of balance as to cause a collapse. So while the stock market was rising, banks also invested heavily in the stock market. In essence, they were gambling with their depositors' money. The stock market crashed. Banks lost a lot of money in this process. The depositors who had put their life savings in the banks lost all this money because there was massive hemorrhage of the economy. Lots of factories and businesses closed down. Unemployment went from under 3% to over 20% for decades. Farmers were unable to plant crops because they didn't have enough money to invest in their lands. As a result, there were a lot of marginal lands which required continuous attention in order to sustain agriculture. These became uncultivable and created what was called a dust bowl where nothing grew. So there was a huge crisis, mainly because banks gambled with other people's money. And this is what led to regulation. I would argue that the root cause of the depression was a social failure. That is, the banks were making profits for themselves by gambling with other people's money. But this root cause was not addressed. In fact, what happened was institutional reforms were made which were quite successful. And so institutional and structural reforms, that's the second dimension along which we can compare Islamic ideas to current Western ones. And first we go into the structural and institutional reforms that were made following the crisis of 1929. Basically, the Securities Exchange Commission was formed, which was to deal with malpractices in the stock markets, to make sure that people were not doing bad things, bad practices of many types that can be done with stocks. At the same time, there was the Federal Deposit Insurance Corporation, which made sure that if a bank gambled with people's money, the government would be there to back it up and insure it. It's not really such a good idea, in the sense that it increases the incentive of the bank to gamble, because now they don't have to the consumer or the depositor is safe in any case, so they don't face the responsibility. Because of this, this was understood. So there were many regulations on the behavior of the banks. The banks were forbidden to speculate. They were forbidden to invest in stocks. There were many measures taken to reduce competition in the banks so that they would not have to compete with each other to offer higher interest rates. Banks were regionalized. No bank could have branches in more than one state. There were caps on interest rate payments, so they could not, and no one could pay more than the maximum interest rates. And other measures were taken to make sure that banks would not gamble. There was the Glass-Steagall Act, which put a barrier between banks and finance. There could be investment banks which dealt with stock markets and investment, but normal commercial banks which held savings could not have any relationship with the commercial banks, and they could not invest in stocks. So anyway, these were the structural regulations that were put in place to prevent bank failures, which had occurred in Great Depression, and these structural regulations worked very well for a long time. So that brings us to the second dimension in the Islamic approach to financial regulation. This second dimension is structural. By structural, I mean that it concerns the structure of the institutions, the financial institutions. For example, as we have seen in the wake of the Great Depression, the banks were forbidden from speculative activity, and it was seen that their main purpose was basically to keep the money safe for depositors and to earn them a small amount of interest by making very safe loans. Banks were not allowed to make risky loans, and in addition, there were investment banks which were allowed more freedom, but everybody understood that if you put your money in your investment bank, it may not be safe. The conventional banks were also guaranteed, so that if the banks didn't end up making mistakes, the government would step in and bail out the depositors. So basically, we're not talking about regulations here so much as how to structure the financial industry. Now, Islam has its own unique way for structuring the industry of finance, and this is because Islam has its own unique approach to the idea of what is to be done with money. So basically, as we have discussed earlier, the spirit of capitalism is the preservation and the accumulation and the hoarding of wealth, and the institutional structure of a capitalist society is designed to facilitate these functions. As opposed to this, the spirit of an Islamic society is to spend on others and to provide service, and the nature of the financial institutions is also accordingly quite different. We have no time to discuss the structure in detail in this present talk, because our focus is rather different. I have discussed an outline of how genuine Islamic financial institutions would be structured in another paper of mine called Building genuine Islamic financial institutions, and the reader is referred to that paper for a more detailed discussion. Here we just provide a bare bones outline. So basically, one of the institutions of an Islamic structure, financial structure, would be a Darul Amana, a place where one can keep money safe. This resembles the commercial bank as conceived in the post-depression era, not current commercial banks, because they have escaped the regulations that were imposed in the post-Great Depression era. The Darul Amana would just be a place where people can keep their money safe. One important problem that modern Darul Amana would face is that the value of money itself is not stable, and Darul Amana would have to take some special measures to make sure that people get back what they put in value terms, in approximately the same amount they put in, they should get back in value terms. So that's one type of institution. Another type of institution would be service-oriented saving, not because the capitalist society allows people to just accumulate and hoard money without any purpose, so general purpose banks are fine. But in Islam, one is not allowed to just accumulate and store money and pile money upon money without any purpose. In fact, this is explicitly prohibited in the Quran, that people who accumulate money without intending to spend it for the sake of Allah are condemned. So more than general purpose banks, Islam would have institutions which would be special purpose, service-oriented savings institutions. One example of this already in existence is the Tabang Haji in Malaysia, which allows people to save up money for Hajj. Similarly, one could have building societies which allow people to save up money for housing. And similarly, other special purpose needs could have special purpose institutions which would act in a far more efficient fashion than the general purpose banks, because not only would they allow people to save money, but they would facilitate the provision of services. The building societies would help people to construct and to build and to buy homes. So the point of this is that the savings institutions would not be just a place to store money, they would also be providing various kinds of services in accordance with the spirit of the Islamic society, which is that money is earned by providing services, not by financial speculation. One of the key financial institutions in an Islamic society is a waqf, which allows people to spend their excess money on others in a systematic and sustained way. Similarly, the investment bank allows people to risk their money in trading ventures so as to earn a profit. And this is one very important distinction between the Islamic conception of financial structures and the Western one. That is, one is not allowed to make money on money, that is interest. Rather, one must use one's money in trade in a way that participates in the trade, so that the owner of the money engages in the risks of doing business in order to be able to earn a profit. This is what justifies the return, and this is what makes it halal or permissible. So anyway, these are the structures of a financial institution, in an Islamic world. They are very different from existing financial structures in the Western world, and these structural innovations would in fact substantially reduce the risk of financial crises, as has been realized by many different authors. As I've said before, the structural the structure of financial institutions that was put into place following the Great Depression was pretty good, and it served to prevent bank failures. There was hardly any serious bank failures for about 40 years following the Great Depression because of the fairly good structure. But as I've said also, this structure did not address the root cause, which was the social failure. This did not matter because for 40 years the generation which had witnessed the Great Depression was alive and they had these memories, and so the social cost of Great Depression was known to all people, and therefore there was implicit social norms that prevented banks from trying to go outside of the barriers placed upon them. But by the 70s, more or less the last of this Great Depression generation was dying out, and the memories of the Great Depression had been forgotten, and so the banks started to try to wriggle out of the constraints placed upon them in the Great Depression. So there were a few loopholes in the Glass-Steagall Act. There was no change in the laws, but now the social norms changed, and the banks started becoming more hungry for profits and more hungry for deposits, and they started to try to compete with each other on different dimensions. So one of the loopholes in Glass-Steagall Act was that although banks cannot directly invest in the stock market, if some customer wants them to do so, they can do so on his behalf. Also, the bank could not affiliate with other companies investing in the stock market. That was to keep them out by using an indirect method. But there was a provision that if there was a company whose main business was not stock markets, then the banks could affiliate with it. So these were loopholes, and the banks started utilizing these loopholes to do more and more speculation, and also they were able to start certain ambiguous types of accounts which were called now accounts, and they were able to offer higher interest rates than was allowed for. There was a maximum ceiling, but this ceiling was breached by these now accounts who could offer higher interest rates by using again some structural legal loopholes in the acts which regulated banking. So it was not so much the failure of the structures as the social environment which has changed. The banks were now trying to make more profits, they were trying to invest more, and they were trying to get around the regulatory, the barriers that were placed by the laws. So I've said that this was a failing more of the character, more of the social barriers than of the institution and regulation structures. And so basically, as I've said, the effects of greed had been seen by everyone, and so the banks were extremely conservative and did not do anything speculative for a long time. But this environment changed in the 70s and we will now see the results of this change. There were two key lessons that were learned by economists in the Great Depression. Both of these were actually part of Keynesian economics, which was the dominant school of thought in economics up until the 70s. One of these lessons was the one that was obvious for all to see, that speculative behavior by banks can lead to collapse, and therefore one needs to have strong financial regulation to prevent this from happening. And the second lesson was that there was massive unemployment for decades, which meant that economic system by itself is unable to provide jobs for all. This is actually contrary to the teaching of conventional economic theory. According to conventional economic theory, supply and demand in the labor market will automatically lead to full employment. But this was observed not to happen. So the Keynesian economic theory provides an explanation and says that it is possible that there is unemployment, but the wage will not fall to eliminate it, and therefore it's the job of the government to reduce unemployment by following various types of fiscal and monetary policy. So these two big lessons led to a fairly good performing economy in the post-World War era. But in the 1970s, certain developments which we cannot discuss here, I have discussed them in some other papers, led to the forgetting of these lessons. Basically, the school of monetarist economists in Chicago widely proclaimed that Keynesian economics was all wrong, and that these lessons that we are describing are not actually correct interpretations of the Great Depression. The monetarists argued that it was not misbehavior of the banks and financial institutions which led to the collapse of 29. Rather, it was misbehavior of the government. The government did not properly handle the money supply, and that is what caused the collapse. So this was a complete radical reinterpretation of what actually happened in the Great Depression. It is in fact a completely wrong interpretation, but it became widely accepted, and the Keynesian ideas were discredited. The monetarists also said that the unemployment was again caused by bad government interference, and if the government had not interfered, then this unemployment would not have persisted. So basically all of the problems of the Great Depression were blamed on the government instead of being blamed on private sector. This school of thought became dominant, and it did not become dominant, but it became much more popular, and Keynesian became on the defensive because some of their theories were not matching with economic events in the 70s, where there was stagflation, where there was inflation and at the same time large unemployment. This was caused by the oil shock crisis, but this was something which was against the basic ideas of Keynesian economics. So an opportunity was created to go back to the pre-depression economic theory and also to the pre-depression economic practice in terms of lack of regulation and allowing banks and financial institutions to do whatever they wanted to do. So going back to the pre-depression economic theories and the pre-depression economic practices led to the same event that had happened, namely financial collapse and crisis, as we will soon see. Very surprisingly, the collapse of Keynesian theories led to the re-emergence of the very same theories that had led to the Great Depression of 1929 in the first place. All of the lessons of the Great Depression were rapidly forgotten, and actually the coming to power of Reagan and Thatcher was the symbol of the re-emergence of old economics, pre-depression economics. which did not, which considered that there should be no regulations by the government of anything. So Reagan announced with great fanfare the Garn-Saint-Germain Act of 1982, which deregulated the savings and loan industry. Prior to this, there had been many restrictions on savings and loan associations, which were meant to be community associations, which were very conservative and very strict about protecting the wealth of the depositors. In addition to deregulating, there was insurance created for the savings and loan industry, which again made it very easy for the industry to gamble. There were many restrictions that were on entry, that people had to prove their financial reliability. All of these restrictions were removed, and as a result there was a major crisis. People took advantage of this deregulation to systematically steal $100 billion from the depositors. Because there was so much money, there was collaboration at the highest level with congressmen and everybody involved in getting a share of the pie. A book which documents all of this is called Inside Job: The Looting of America's Savings and Loans, by some people who were deeply involved in regulating the crisis. So basically, the deregulation of the savings and loan led to the loss of, it has been estimated, the entire profit made by the banking industry from the whole 20th century basically. So, and it was an enormous amount of loss, and the government had to step in and bail them out in order to prevent another financial depression. So when the lesson was forgotten, as it is said in a proverb, that those who don't learn from history are destined to repeat it. So when the financial regulations were dropped, then something quite analogous to what had happened in the Great Depression recurred. The savings and loans behaved irresponsibly with the depositors' money, and they lost it all, to tremendous loss of depositors. And in this case, the depositors were protected by the government, but there was a tremendous cost which had to be paid by everybody in the economy instead of just the depositors. So what were the causes of the 80s savings and loan crisis? Well, the most fundamental cause was the lack of social controls. People were quite happy to make profits for themselves, even though they would inflict harm on millions of others. There was a systematic looting of the savings and loan, taking advantage of the deregulation. So basically it was a culture in which it was considered a good thing to make a profit, regardless of how you made the profit, regardless of how many you hurt. Now in Islam, all of your earning must be halal, which means that it must be earned, it must be deserved. If you make money, there must be something you do to justify the making of it. So you must deliver value. This concept is completely out of the calculus in the West. Even now, there is no concept of halal earnings. And this is one of the key social institutions of Islam, which would be sufficient to prevent crises. If everyone considered that when I earn money, it must be justified by my doing something which is worth that money. So the savings and loan industry wanted to make profits without adding any value to society. That's one of the lessons. The second thing is that deregulation was done by the powerful purposefully to make profits. So this is always a problem, that regulation will work provided that the regulators are pure and sincere and not profit motivated. So this is a dual model. That is, in the society there are some people who are just and fair, and these are the people who run the society, who regulate, who make the laws, who deliver justice, while the rest of the society is corrupt, running purely after their own personal profits and selfishly looking for their self-interest. So this kind of a dual model cannot be maintained for a very long time, because what happens is that the selfishness and the corruption and the looking for self-interest goes up outside of the trading arena, and the regulators and the lawyers and the parliaments and the congresses, they all also become self-serving and seeking for profits. So in that case, the idea of regulation becomes impossible, because the regulator can always be purchased by the one being regulated. So as the consequence of the savings was a huge loss to the economy, this time the people didn't actually directly get hurt, the depositors, because they were bailed out by the government, but the cost of the crisis was paid by the whole society, and there was a huge cost to the economy. There have been a large number of other financial crises which also similar patterns. Basically, some people in the finance industry are able to speculate and gamble with other people's money and not have to pay the consequences of if their gambling goes astray. And then so irresponsible behavior is quite common and leads to crises. The biggest of these, of course, was the subprime mortgage crisis, which occurred recently and directly caused the global financial crisis of 2007. Basically, the Glass-Steagall Act, which prevented banks from speculating, was repealed in 1999 by the Gramm-Leach-Bliley Act. Basically repealed the Glass-Steagall Act, and it only took about 7 or 8 years for the whole cycle to repeat. So it was a very rapid process. The banks immediately started gambling, and eventually they went broke, and that is what caused the crisis. The immediate cause was the mortgages. Mortgages were sold very irresponsibly. Again, there is a very nice movie which explains this, which interestingly has the same name as the book we cited earlier. The movie is also called Inside Job, and it shows how unnecessary risk-taking by banks led to this crisis. One important element of this crisis was the insurance industry. Banks made extremely risky mortgages, which they would never have done otherwise, but they were able to buy insurance for this. The insurance company was one which was too big to fail. So when the banks had insurance, then they could take very risky mortgages, because even if the mortgage failed, the insurance would cover their losses. At the same time, the insurance industry was convinced that if there was a massive crisis, and there was, then the government would have to bail them out, because if the government allowed the insurance industry to fail, then the entire financial structure would collapse. So there are actually many things that were done in this process which led to the global financial collapse. Many of these things were contrary to Islamic law. So Islamic law of finance For one thing, it prohibits the trading of debt. This was one of the key elements of the mortgage crisis. Islamic law prohibits gharar, that is the sale of assets which have very uncertain value. In fact, many of the assets that were traded prior to the crisis were very complex derivatives of which no one understood exactly what the worth was and what the value of these derivatives was. So if Islamic laws had been followed, then this crisis would not have occurred, and this is something which has been realized by a large number of people, including Western secular observers. So as we have seen, the global financial crisis occurred not because of some extremely new and rare circumstances, but basically for the same reasons that the Great Depression occurred. The lessons that were learned from the Great Depression were forgotten, and all of the things that had been prohibited in the wake of the Great Depression were allowed, and this allowed the Great Depression to recur. So now one would think that the global financial crisis would lead to a relearning of those lessons, and one would see something of the same type of regulation that happened after the Great Depression of 1929 that prevented this type of event from happening. But in fact, post-crisis, the situation has been quite different. There has been an extreme reluctance to regulate, although people keep mumbling and saying that regulation should be done and macroprudential regulation is necessary. There is a lot of noise, but there is no action. So this is a little bit puzzling, because it seems that a huge crisis has occurred and one should be taking steps to prevent it, but this is not happening at all. Why is this? Well, to understand this, you have to understand that there has been regulatory capture. The government and the regulators are now much more deeply in the pockets of the multinational corporations, and the multinational corporations and the big bankers are firmly in control, unlike what was the case following the Great Depression. So because they are in control, and because the crisis hurt everybody but did not hurt the top 1%, this is very important to note, that the global financial crisis destroyed a lot of people, made a lot of people homeless, made a lot of millions of people hungry, but did not have any harmful effect on the bankers and on the multinational corporations which caused this crisis. In fact, the trillions of dollars in bailouts were given to those who caused the crisis, and they were not given to those who were suffering from the crisis. So the consequences of the crisis have been very good for the elite, the ones in power, the ruling class, and they have no incentive to regulate and to cause, to prevent future crises, because they don't get hurt by such crises. So as a result, the analog to the Glass-Steagall Act is now the Dodd-Frank Act, which is supposed to do something similar. That is, it is supposed to prevent banks from speculating. But in fact, as everybody realizes, this is hopelessly complex, and it contains, the more complex the legislation, the more likely it is to contain loopholes. So Dodd-Frank Act is 848 pages, whereas the Glass-Steagall Act was only 37 pages. So it was a simple and clear restriction, whereas the Dodd-Frank, nobody understands it's a monstrosity, and it is designed to be a monstrosity. It is designed to give banks the opportunity to act in ways which they want to, while having a cover that there is some regulation. So basically what we are seeing is regulatory capture on a huge scale, and so the idea of what we should make as macroprudential regulations, which is being discussed, what are the rules that should be in effect, is sort of a useless discussion, because the point is that there has to be will, there has to be power, and this power is currently in the hands of the very people whom we want to regulate. So the first issue would be to how to acquire the power. Otherwise there is nothing new or difficult about regulating. So I think that the first step is to reform social norms and institutions and then regulate. Now, how can we reform these social norms and institutions? Well, one of the places to start is the business schools, which teach that you can do anything for a profit and the bottom line is everything. This has to be changed, because regulations cannot function when the social norms are wrong. So we have to inculcate social norms into our business leaders. We have to teach them that their goal is to serve society, not to exploit society, and they have to conserve nature, and they have to protect ecology, they have to protect life on the planet, they have to be responsible stewards for the next generation. All of these are ethics and values which Islam teaches very clearly, but are currently not part of education in the West. And until these ethics and values become part of the education, simply passing laws and making regulations will not be successful in preventing crises from occurring in the future. So to conclude this discussion, we summarize some of the main points that we have been trying to make in this lecture. Basically, the West experimented with a dual structure of controls. The traders, the financial markets, are allowed to be wild, they are allowed to be profit-seeking, they are allowed to be greedy, selfish, and just accumulate wealth without regard for anything else. But there is going to be some regulators who are watching over them and who are taking care of them. These regulators should be honest, just, ethical, and they should ensure that the traders don't do any harm to each other or to society. Well, this dual structure fails because once you allow the traders to be selfish and profit-seeking, this ethical norm becomes pervasive throughout the society, and the regulators themselves are also corrupt and profit-seeking and selfish, and so they cannot do the job that they are supposed to do. And this is why morality and good social norms are the basis of the Islamic approach. Once we teach our children to be generous, cooperative, to look out for others, to sacrifice one's personal benefits for the sake of society, then these type of regulation problems will not arise. With this type of social norms, a different type of social structure and financial institutional structure will result. These issues have been discussed in some other articles of mine. One point to note is that some realization of this has occurred in the West also, and courses on morality and ethics and corporate social responsibility, etc., have been introduced in nearly all business schools. But these are unlikely to work because the fundamental profit ethic has not been changed. So even when we talk about social responsibility, about business providing service, all of these are seen as means to making even more profits. It is thought that if we improve our image, it will lead to more profits. So as long as this is just the service and the responsibility is just an image, it will not have the desired effects, because whenever an opportunity for profit arises that is superior to being socially responsible, then the opportunity for profit will be taken. So the Western secular approach cannot work, and this means that Islam and Islamic approaches have a lot to offer, which is currently not on the menu of reforms in the West. And so Islam, when it came 14 centuries ago, became the world leader because of its unique message. Islam has the same potential today if Muslims were to adopt it and to demonstrate it as a living model instead of as a theoretical possibility which is written on our books but not practiced in our lives. May Allah give us the tawfiq to live according to the religion which is the most perfect one that was given to us by Allah. Subhana rabbika rabbil izzati amma yasifun wa salamun al mursaleen walhamdulillahi rabbil alamin.